Hedge accounting sounds complex, but it is really about matching the timing of gains and losses on a company's financial records. A hedge is essentially an insurance policy. It is a tool businesses use to offset the risk of price changes in their assets. Without hedge accounting, a company might show a massive profit one month and a huge loss the next, even if their business is stable. Investors prefer predictable performance. Hedge accounting allows companies to smooth out those bumps caused by market fluctuations like fuel or currency prices. Standard rules force you to report gains and losses when they happen, but hedge accounting lets you pair them up to reflect reality. This chart shows how hedging creates a steadier picture, helping stakeholders see the true health of the core business rather than just market noise. Remember that this is a technical choice companies make to be transparent about how they manage their financial risks. Understanding these concepts helps you read financial statements more effectively. Check the description for more resources and subscribe for more finance basics.